Bismillahirrahmanirrahim. Assalamu alaikum. Hello everyone. Hope all of you are well by the grace of Almighty. I am also well by His grace. Today I am going to take a class on management accounting. The class is for the student of Master's Preliminary and for the student of BBA third year of Management Department. This is Nasrul Al Mamun, lecturer, Department of Management, Government Ispahani College is conducting the class. Our today's class chapter name is Cost Volume Profit Relationship. First of all, you should know chapter outline. After completing this chapter, you will be able to understand introduction, calculation for a CVP analysis, using a CVP to target a desired profit, break-even point, computing the break-even point. These are the chapter outline. Dear student, look at the slide. Cost, volume, profit relationship. Here there is the three elements: cost, volume, and profit. The relationship among these three elements is called cost, volume, profit relationship. And to understand the cost, volume, profit relationship, you should know, but you have to understand what is cost, what is volume, what is profit. Cost, which means the expense involved in producing or selling a product or services. And volume means sales volume. Volume means the amount of goods and services sold. And profit means the difference between sales and cost. And you know, cost, volume, profit analysis is very much essential for any companies for make a decision. We know that managers and accountants in every organization try to make the sales decision and whether the products should be run or not. So it is very much important for every companies to analyze the cost, volume and profit relationship. In abbreviate form, cost, volume and profit relationship, it is called CVP, cost, volume, profit. CVP, the study of the effects on future profit of changes in fixed cost, variable cost, sales price, quantity and mix. Cost volume profit analysis is used to determine how changes in cost and volume affects a company's operating income and net income. In performing this analysis, there are several assumptions made, including there are three assumptions. Sales price per unit is constant, variable cost per unit are constant, total fixed costs are constant. Here I showed three assumptions, but there are also some assumptions, but these three assumptions is very much important. Now I am going to the another slide. It is a graphical representation of break-even point, and there are several lines and how cost, variable cost, revenue, and shows the lines. Please look at the chart. Here there is a vertical axis, it shows the revenue or cost. In the horizontal axis, it shows the level of activity or units. And please look at the red color line, that is also in a horizontal. It shows the fixed cost, and it shows the variable cost. It is the total cost. This line is total cost line, and it is revenue or total revenue line. And here this is total cost line. This is fixed cost and variable cost, and it is total cost. And after break-even point, it shows revenue. Here is revenue, and that point is the BP point, break-even point, where total cost line and revenue line mixed, where total cost line and revenue line mixed is called, or intersect is called BP. This is the BP point. BP means where there is no loss or no profit, and after this, uh, after BP, a company's earn profit, but below the BP, a company cannot earn profit. So in the next classes, I will try to give a proper concept about the BP. Now it is in an abbreviate, a concise concept. Please, I will give a brief. I will give a details in the next classes about VEP. Dear student, look at the slide here. There is another definition of CVP analysis. What is CVP analysis? Cost volume profit, or that means CVP analysis is a technique used to determine the effects of changes in an organization's sales volume on its cost, revenue, and profit. That means cost and sales volume, how much effect cost and sales volume on profit. Cost may be increased, sales may be increased or decreased, cost may be increased or decreased, and how much effect it has on profit. It shows the CVP analysis. In simple word, cost volume profit, hereafter CVP analysis is the most fundamental tool because it provides straightforward ways to study the effects of changes in cost and volume on company's profit. Key terms and concepts. Here there are several key terms. To realize this chapter properly, these key terms is very much essential, and all of you have to understand these key terms completely, thoroughly, and it will help you to realize the chapter. First of all is the contribution margin. Second, contribution margin percentage or ratio. Variable cost or expense. Fixed cost. Operating income. Break-even point. Break-even sales. Break-even number of units sold. These concepts and key terms will help you to realize the chapter. Now I want to give a general concept about contribution margin. How do you mean by contribution margin? One of the key relationship in CVP analysis is the contribution margin. In an abbreviate form, it is called CM, contribution margin. Contribution margin is the excess of revenue over the variable cost of generating that revenue. That means here there is rules. Please attention, please look at the rules. Contribution margin is equal to sales minus variable cost. That means subtracting variable cost from sales, you will find the contribution margin, that is CM. Here there is an example. We will use following relevant data to understand various important issues relating CVP analysis. Please, dear student, look at the example. Here there is an example of a company. Unit selling price taka 50, unit variable cost taka 30, total monthly fixed cost 20,000, total units sold 1,000 units. And therefore, if you follow the previous rules, contribution margin is equal to sales minus variable cost, and here there is a 100 units sold into 50 taka minus 100 unit 1000 units 1000 units into 30 taka variable cost. It is variable cost, it is selling price. So the after calculating this, we will find the contribution margin is taka 20,000. And this example will be you have to follow in the next slide. I'm going to next slide. Contribution margin ratio. The contribution margin ratio or contribution margin percentage, you can say PV ratio. The contribution margin ratio represents the proportion of total sales that remains after the variable cost have been subtracted. This ratio is computed as follows. Contribution margin ratio, this is the rules. Contribution margin ratio is equal to total contribution and total sales into 100. That means total contribution margin divided by total sales into 100, we will find contribution margin ratio. Therefore, if you calculate the previous example, you will find 40%. Here there is 20,000 is contribution margin, 1,000 units into 50 taka, which is the total sales, into 100. You will find the CM ratio 40%. It is very easy. If you try in your house, then you will find that it is very much easy. Please, dear student, please follow another example. The 2004 sales of Mishu company were 76,40,000. Fixed cost was taka 24,000, 24,51,000, and variable cost total taka 47,36,800. Required. You have to calculate, compute the contribution margin ratio. And if you follow the previous rules, then you will find that it is very much easy. Contribution margin, sales minus variable cost. If you calculate, then you will find the total sales 76,40,000, variable cost 47,36,800, and it will be the contribution margin 29,03,200. Contribution margin ratio, total contribution margin by total cost, total sales into 100, then you will find it 38%. Please, dear student, try at your home. If you are able to understand this chapter properly, there are many other rules, and here I am showing some basic rules, but beside this there are a lot of rules, and how much rules you able to memorize, then it will be very much helpful for you to understand this. Basic equation of margin and costing. Profit is equal to sales minus total cost. Profit is equal to sales minus variable cost plus fixed cost, and profit plus fixed cost is equal to sales minus variable cost. Sales minus variable cost is equal to contribution is equal to fixed cost plus profit. Contribution minus fixed cost is equal to profit. And you can make some other rules by following this, and all rules shows the many other rules can create. And thank you all, and I will take another class immediately, and please follow all the classes. Thank you everyone.